Welcome back. Well, let's welcome on board the management of Strides Pharma now. Mr. Arun Kumar, the Executive Chairperson, is with us. Hi, Arun. Good to be speaking with you. It's a good set that you have reported, largely in line with your expectation of 12 to 15% growth. You've actually bettered that with a 17% growth in the quarter, with the US revenues coming in at a historic high of $70 million. Talk to me about the US business a bit more. Do you expect this momentum to sustain? And how's Suprep really doing for you in terms of market share right now?
Yeah, thanks. Good afternoon. Thanks for having us. Anisha, yeah, we are significantly ahead of our outlooks and quite pleased with our Q1 results. The US numbers have significantly benefited from Sucralfate launch. We now have a little over 30% of the market share, and we expect to continue holding on to a nice product launch that we have had. Of course, we have a new approval of Sucralfate, which will be launched next quarter. So consequently, we are now comfortably poised to be in the mid-range of the $285 to $300 million US revenues, if not at the higher end. So it has been a good set of numbers across markets and segments.
A bit more about the Sucralfate oral suspension drug that you talked about, that you've got the approval. What will be the launch timeline? What kind of market are you looking at tapping there? What could be the market share perhaps?
Well, typically we end up between 25 to 30% of market share on any key product that we launch. It takes us a good 2 to 3 quarters to get there. So I can't put a specific number, but it could be another important product for us in the near term.
The other thing I wanted to talk about, Arun, was OneSource. Last we know is that one of your partners was expecting approvals on this. Could you share any timeline? When is it that you're expecting commercialization?
Asha, hi. We've actually guided in our deck today that we expect commercial sales of our first GLP in this financial year. Commercial sales from OneSource is already commenced for other products, but for the GLP, which is a big leg up for us in terms of opportunity, will potentially happen in H2. Our partners' approvals are on track.
About the US business, I just want a bit more color about how the price erosion situation is on the ground. Is it still very acute, or is it abated a bit?
Well, I constantly use every opportunity to say that our portfolio is slightly different. We have had very significant and consistent margin profile in the US. Remember, we have little over 250 products. We have a very calibrated approach, and consequently only 67 products are currently in the market, which allows us to ensure that our products take care of price challenges. We have not seen price pressures for almost 90% of our portfolio for many quarters, and it's been consistent. And if our margin growth has been consistently adding Q on Q, it's simply because we are able to maintain our pricing in the US.
Correct me if I'm wrong, but I do understand that you have been divesting some of your non-core assets, whether it was OSD facility in Singapore or your deal with Syngene with respect to Stelis as well. How's that aiding the overall return ratios? How will the going away of the Stelis business, for instance, help your overall scheme of things?
Well, so the OSD business is related to Strides, and that obviously everything that we set out when we came back to run the business in terms of network optimization has been complete. That obviously is resulting in better OPEX leverage, lower costs, and improved margins. Specifically to the site that you're referring to on the sale to Syngene, it's not related to Strides. It's a OneSource site, which is a new CDMO business that's been carved out and should be listed later in the year. That was a vaccine site that we set up for Sputnik, and with whatever happened with Sputnik, and then finally we did sell that facility to Syngene. And that also aids, obviously, OneSource's ability to have much better returns. So you're right, both the companies or both the divisions are benefiting from those actions that we've taken. All of those corporate actions that we announced are now completely behind us. And this is a time for us to be focusing on continued growth from where we are now.
Continued growth, are you looking at, let's say, 15 to 20% growth from here on for the next few years with margin profile of 20-22%, or what the medium term output would really look like for you?
Well, I think we're fairly reasonably on spot with our guidance. So this year we have guided for a 15% growth, and Anisha, as you correctly said, we are a little ahead of it this quarter, but that's also because we had a nice Suprep launch. So I would still stick to that 15% outlook, but 20 to 20% EBITDA is definitely on track, which is what we would be more aiming towards the higher end of the range. We are pleasantly surprised by the fact that we've been able to achieve that as early as Q1. So that's a bonus. So maintaining that and growing from that level should be reasonable, I would assume. And so at 1 year at a time, especially when we're coming back after a very significant course correction that is now fully in play, and the past is behind us.
Right. Great to have you on the show, Arun. Thank you so much for making the time out and speaking with us today.
Thank you. Thank you, Aisha and Anisha. Thank you. Have a great day.